Hello and welcome to today's episode. The episode will tell you about ratio analysis. We have discussed few accounting ratios, that is, liquidity ratios and solvency ratios in the earlier episode. In this episode, we will discuss two more ratios, that is, activity ratios and profitability ratios. I am Garima Surana and the script is written by Dr. Arshia Hussain, teaching in the Center for Management Studies, Jamia Millia Islamia University, New Delhi. We will start with the activity ratios. Activity ratios are used to measure the effectiveness with which a concern uses its resources. It is also known as turnover ratios, as it reflects the extent with which the assets are converted into sales. The business would be more profitable if greater turnover is achieved with lesser use of funds. In other words, a high turnover ratio indicates a better use of capital or resources. The important activity ratios are capital turnover ratio, fixed assets turnover ratio, working capital turnover ratio, stock turnover ratio, debtors turnover ratio, creditors turnover ratio. This ratio establishes a relationship between net sales and capital employed. This ratio determines the efficiency with which capital employed is being used in the business. A high capital turnover ratio is considered to be favorable as it indicates higher profits. However, a very high ratio is a sign of overtrading, which can lead to scarcity of funds. This ratio is calculated as follows. Capital turnover ratio is equals to net sales divided by capital employed, where net sales is equals to sales minus sales returns. Capital employed is equals to shareholders' funds plus long-term debts. Question. Calculate capital turnover ratio from the following. Sales rupees 1,51,000. Capital employed is equals to rupees 2,40,000. Solution. Capital employed is equals to sales divided by capital employed is equals to rupees 1,51,000 divided by rupees 2,40,000 is equals to 0.62. Question. Calculate capital turnover ratio from the following. Fixed assets rupees 1,20,000. Working capital rupees 60,000. Cost of goods sold rupees 6 lakh. Gross profit rupees 1,20,000. Solution. We know that capital turnover ratio is equals to net sales divided by capital employed is equals to rupees 7,20,000 divided by rupees 1,80,000 is equals to 4 times. Fixed assets turnover ratio shows how efficiently the fixed assets are being utilized in the business. A high ratio indicates a better performance. On the other hand, a low ratio indicates that fixed assets are not being efficiently utilized. This ratio is calculated as follows. Fixed assets turnover ratio is equals to sales divided by fixed assets. Question. Calculate fixed assets turnover ratio from the following. Shareholders' funds rupees 5 lakh, long-term debts rupees 3 lakhs, working capital rupees 2 lakhs, sales rupees 12 lakhs. Solution: fixed assets turnover ratio is equals to sales divided by fixed assets. Fixed assets is equals to capital employed minus working capital is equals to rupees 5 lakhs plus 3 lakhs minus rupees 2 lakhs is equals to rupees 6 lakhs. Therefore, fixed assets turnover ratio is equals to rupees 12 lakh divided by rupees 6 lakhs is equals to 2 times. This ratio indicates the speed with which working capital is turned over into sales. In other words, it determines the efficiency with which the working capital has been utilized in the business. Working capital is calculated as follows. Working capital turnover ratio is equals to net sales divided by net working capital, where net sales is equals to gross sales minus sales returns. Working capital is equals to current assets minus current liabilities. Question: calculate the working capital turnover ratio from the following. Sales is equals to rupees 2 lakhs. Current assets is equals to rupees 1 lakh. Current liabilities is equals to rupees 75,000. Sales returns is equals to rupees 25,000. Solution: working capital is equals to current assets minus current liabilities is equals to rupees 1 lakh minus rupees 75,000 is equals to rupees 25,000. Net sales is equals to rupees 2 lakh minus rupees 25,000 is equals to rupees 1 lakh 75,000. Working capital turnover ratio is equals to net sales divided by net working capital is equals to rupees 1 lakh 75,000 divided by rupees 25,000 is equals to 7 times. Stock turnover ratio measures the relationship between the cost of goods sold during a given period and the average amount of stock or inventory carried during that period. This ratio determines the efficiency with which the stock is utilized. It indicates the speed with which the stock is turned over into sales. The ratio is calculated as follows. Stock turnover ratio is equals to cost of goods sold divided by average stock, where cost of goods sold is equals to opening stock plus purchases plus direct expenses minus closing stock, or cost of goods sold is equals to sales minus gross profit. Average stock is equals to opening stock plus closing stock divided by 2. Higher the ratio, better it is for the firm, since it indicates that more sales are being produced by a rupee of investment in stocks. A high stock turnover ratio implies a better inventory management. On the other hand, a low turnover ratio indicates the accumulation of obsolete stock which is not saleable. Question: calculate the stock turnover ratio from the following. Cost of sales rupees 4,50,000. Stock at the beginning of the year rupees 1,25,000. Stock at the end of the year rupees 1 lakh. Solution: stock turnover ratio is equals to cost of goods sold divided by average stock. Cost of goods sold is equals to opening stock plus purchases minus closing stock is equals to rupees 60,000 plus rupees 3,30,000 minus rupees 3 lakhs is equals to rupees 90,000. average stock is equals to opening stock plus closing stock divided by 2 is equals to rupees 60,000 plus rupees 90,000 divided by 2 is equals to rupees 75,000. Stock turnover ratio is cost of goods sold divided by average stock is equals to rupees 3 lakhs divided by 75,000. Thus, stock turnover ratio is 4 times. Debtors turnover ratio establishes the relationship between net credit sales and average debtors of the year. Average debtors are calculated by dividing the total debtors in the beginning and at the end of the year by 2. This ratio is used to test the efficiency or speed with which the debtors are converted into cash. A high ratio is considered favorable since it indicates a successful credit policy. This ratio is expressed in number of times. This ratio is calculated as follows. Debtors turnover ratio is equals to net credit sales divided by average debtors. Question. Calculate debtors turnover ratio from the following. Gross sales rupees 8 lakhs. Debtors in the beginning rupees 75,000. Debtors at the end rupees 1,25,000. Sales returns rupees 50,000. Cash sales rupees 1,50,000. Solution. Debtors turnover ratio is equals to net credit sales divided by average debtors. Credit sales is equals to gross sales minus cash sales is equals to rupees 8 lakhs minus rupees 1,50,000 is equals to 6,50,000. Net credit sales is equals to credit sales minus sales returns is equals to rupees 6,50,000 minus rupees 50,000 is equals to rupees 6 lakhs. Average debtors is equals to rupees 75,000 plus 1,25,000 divided by 2 is equals to rupees 1 lakh. Debtors turnover ratio is equals to rupees 6 lakh divided by rupees 1 lakhs is equals to 6 times. This ratio shows the relationship between net credit purchases and average trade creditors. It determines the efficiency or speed with which the payments for credit purchases are made to the creditors. A high credit turnover ratio implies earlier payments to the creditors and a low ratio indicates delayed payments. This ratio may be calculated as creditors turnover ratio is equals to net credit purchase divided by average trade creditors. Question. Calculate creditors turnover ratio from the following. Net credit purchases rupees 1,20,000. Creditors in the beginning of the year rupees 33,000. Creditors at the end of the year rupees 27,000. Solution. Creditors turnover ratio is equals to net credit purchases divided by average creditors is equals to rupees 1,20,000 divided by rupees 30,000 is equals to 4 times. Now we will discuss the next accounting ratio, that is profitability ratios. Profitability ratios measure the effectiveness of the overall management. In other words, it measures profits in relation to sales or capital employed. It indicates the overall efficiency of the management. Following ratios are calculated to measure the profitability of the business. First, gross profit ratio. Second, net profit ratio. Third, operating profit ratio. Fourth, operating ratio. Let's discuss them one by one. First, gross profit ratio. Gross profit is defined as the profit before the recovery of operating expenses. It is the difference between the sales and cost of sales. The gross profit is directly related to sales as it directly varies with the volume of sales if cost of sales remains the same. The gross profit ratio is computed by using the following formula. Gross profit ratio is equals to gross profit divided by net sales into 100. Higher the ratio, the more efficient is the production. Question. A businessman carries an average stock of Rs 80,000. His stock turnover ratio is 8 times. If he sells goods at a profit of 20% on sales, find out his profits. Solution. Stock turnover ratio is equals to cost of goods sold divided by average stock. 8 is equals to cost of goods sold divided by Rs 80,000. Cost of goods sold is equals to Rs 6,40,000. Gross profit being 20% on sales or 25% on cost is equals to Rs 1,60,000. Sales is equals to Rs 8 lakhs. Question. Compute the gross profit ratio. Sales Rs 7,000, gross profit 25% on cost. Solution. Let the cost be Rs 100. Sales is equals to Rs 125. Cost of goods sold is equals to 100 divided by 125 into 7 lakhs is equals to Rs 5,60,000. Gross profit is equals to sales minus cost of goods sold is equals to Rs 7 lakhs minus Rs 5,60,000 is equals to Rs 1,40,000. Gross profit ratio is equals to gross profit divided by net sales into 100 is equals to Rs 1,40,000 divided by Rs 7 lakhs into 100. Net profit ratio. This ratio is very useful to the proprietors and prospective investors because it reveals the overall profitability of the concern. This is the ratio of net profit after taxes to net sales. Net profit ratio is calculated by using the following formula. Net profit ratio is equals to net profit divided by net sales into 100. Higher the ratio, greater is the capacity of the firm to withstand adverse economic conditions. Question. Calculate the net profit ratio from the following. Net sales is equals to Rs 3,50,000. Purchase is equals to Rs 80,000. Cost of goods sold is equals to Rs 2 lakhs. Office and administrative expenses is equals to Rs 40,000. Selling and distribution expenses is equals to Rs 35,000. Interest on debentures is equals to 30,000. Solution. Gross profit is equals to net sales minus cost of goods sold is equals to Rs 4 lakhs minus Rs 2 lakhs is equals to Rs 1,50,000. Net profit is equals to gross profit minus office and administrative expenses minus selling and distribution expenses minus interest on debentures is equals to Rs 1,50,000 minus Rs 40,000 minus Rs 35,000 minus Rs 30,000 is equals to Rs 45,000. Net profit ratio is equals to net profit divided by net sales into 100 is equals to 45,000 divided by 4 lakhs into 100. Net profit ratio is equals to 11.25%. Operating profit ratio. This ratio measures the relationship between operating profits and net sales. This ratio is computed to determine the operating efficiency on the management. It can be calculated in the following way. Operating profit ratio is equals to operating profit divided by net sales into 100. Higher the ratio, the more efficient is the operating management. Operating ratio. This ratio measures the relationship between the costs of goods sold plus other operating expenses to net sales. Operating ratio may be calculated as operating ratio is equals to operating cost divided by net sales into 100. Operating cost comprises A. Cost of goods sold and B. Other operating expenses. Cost of goods sold and administrative expenses, selling and distribution expenses, interest on short-term loans, discount allowed and bad debts. Net sales is equals to gross sales minus sales returns. Operating ratio is very useful in comparing the operational results of the same firm for more than 1 year. It is also useful for inter-firm comparisons. Operating ratio is equals to operating cost divided by net sales into 100, or operating ratio is equals to cost of goods sold plus operating expenses divided by net sales into 100, where cost of goods sold is equals to opening stock plus purchases plus direct expenses plus manufacturing expenses minus closing stock. Look at this question now. Calculate operating ratio from the following. Cost of goods sold is equals to rupees 5,60,000. Operating expenses is equals to rupees 80,000. Sales is equals to rupees 8,40,000. Sales returns is equals to rupees 40,000. Solution. Operating ratio is equals to cost of goods sold plus operating expenses divided by net sales into 100 is equals to rupees 5,60,000 plus rupees 80,000 divided by rupees 8 lakhs into 100 is equals to 6,40,000 divided by rupees 8 lakh into 100. Thus, operating ratio is 80%. The firm calculates various types of expenses ratios in order to measure its operational efficiency. For this purpose, the following ratios may be computed. Materials consumed ratio. It indicates the efficiency in utilizing the raw materials. It is calculated as follows. Materials consumed ratio is equals to materials consumed divided by net sales into 100. Administration expenses ratio. This ratio indicates the efficiency in the occurrence of administrative expenses. It is calculated as follows. Administrative expenses ratio is equals to administrative expenses divided by net sales into 100. Selling and distribution expenses ratio. This ratio indicates the efficiency in the incurrence of selling and distribution expenses. It is expressed as a percentage. This ratio is calculated as follows. Selling and distribution expenses ratio is equals to selling and distribution expenses divided by net sales into 100. Have a look at this question now. Calculate the materials consumed ratio, administrative expenses ratio and selling and distribution expenses ratio from the following information. Opening stock of finished goods rupees 65,000. Closing stock of finished goods rupees 95,000. Materials consumed rupees 2 lakhs. Wages rupees 60,000. Administrative expenses rupees 57,000. Selling and distribution expenses rupees 13,000. Net sales rupees 4 lakhs. Solution. A. Material consumed ratio is equals to material consumed divided by net sales into 100 is equals to rupees 2 lakhs divided by rupees 4 lakhs into 100 is equals to 50%. B. Administration expenses ratio is equals to administrative expenses divided by net sales into 100 is equals to rupees 57,000 divided by rupees 4 lakhs into 100 is equals to 14.25%. C. Selling and distribution expenses ratio is equals to selling and distribution expenses divided by net sales into 100 is equals to rupees 13,000 divided by rupees 4 lakh into 100 is equals to 3.25%. First, return on capital employed. Second, return on equity. Third, return on equity shareholders' funds. Fourth, earning per share EPS. Return on capital employed. This ratio measures the overall performance of the business enterprise. This ratio measures a relationship between net profit before interest and tax and capital employed. Capital employed includes share capital, equity as well as preference capital, reserves, profit and loss account, credit balance, and long-term loans less fictitious assets like preliminary expenses, underwriting commission, and non-operating expenses like investments. This ratio is calculated to find out how efficiently the long-term funds supplied by the creditors and shareholders have been used. In other words, it helps in determining the efficiency of the management in utilizing the capital employed. This ratio is calculated as return on capital employed is equals to net profit before interest and tax divided by capital employed into 100. Higher the ratio, the more efficient the management and utilization of capital employed. Return on equity. This ratio measures a relationship between net profit after interest and tax and shareholders' funds. It indicates the firm's ability to generate profit per rupee of shareholders' funds. This ratio is computed as follows. Return on equity is equals to net profit after interest and tax divided by shareholders' funds into 100. Higher the ratio, the more efficient the management and utilization of shareholders' funds. Return on equity shareholders' funds. This ratio measures a relationship between net profit after interest, preference dividend, and income tax, and equity shareholders' funds. This ratio is computed to find out how efficiently the funds supplied by the equity shareholders have been used. The formula for calculating this ratio is as follows. Return on equity shareholders' funds is equals to net profit after interest, tax, and preference dividend divided by equity shareholders' funds into 100. Earning per share. Earning per share is computed by calculating the profit after tax and preference dividend and dividing the same by number of shares outstanding. Thus, earning per share is equals to profit after tax and preference dividend divided by number of equity shares outstanding. That is all for today. We'll see you with another topic next week. Till then, goodbye.